So what does that mean? You know, is it time to buy? Is it time to sell? Is it a seller's market? Response always to that is, in the past, sellers have been spoiled, right? And now becoming a little bit more balanced.
There's so much to do. There's hula, there's surfing and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
This usually goes for about 45 minutes. It's like timeless. This
Yes.
talk depends. But
a lot of content.
the nice thing about coming to this thing in person is you guys get to ask whatever questions you guys want. So feel free to make it interactive. If you guys have any questions on something we're talking about, make sure you guys raise your hand. We're totally fine just asking whatever. We have a time at the end to do open Q&A. So we're here for the next. We're gonna try to get you guys out here in an hour. Life's short. Time is the most important thing, right? So here you go.
Okay, like Lane said, this is episode 20 for us, the Real Estate Braddahs. Is that top okay?
Yeah.
Okay. Which is the
Down.
oh, wrong way. Okay. So again, that's me, Dean. I'm as I mentioned earlier, I'm a retired CPA. I was 18 years with in public accounting, some in private. In March, I quit to do real estate sales and investing full time. I also to spend more time with my children and my family. Try to get more balance. Yeah. So with that accounting background, I like to use that. And my added value to my clients is to help them be more fiscally responsible in their purchases, especially when you're buying in Hawaii.
You gotta shoot at that.
Oh,
right down there.
Oh. What? As you may or may not know, we do a monthly drawing. So if you listening on Facebook, hope you guys can hear, but putting a comment in, sharing it with your friends, all of this will enter you into our monthly drawing for our Amazon $20 gift card. So this past month's winner, last episode's winner is Lori Hetrick. So Lori, if you're there, I'm gonna reach out for your email if I don't have it, and I will email you a Amazon e-gift card. Okay, thank you for your participation. So as we always start off with, is my part of the presentation is the stuff about Hawaii real estate. So fortunately, the October 2019 statistics came out yesterday, and always mixed reviews, mixed bag of stuff. So for single family homes, we had a 12.3% increase in closed sales at 347. And for median prices, it was a slight decrease of about 2-3%. It was 780,000, down from about 800,000 last October, 1 year ago. For median condo prices, it went up to 441,000, and we also saw closed sales increase 6.5% with 472 units closing. One thing that the Board of Realtors changed this month, I don't know if you guys pay attention to these stats, but this arrow here, as you can see, so we had 23 days on market in October for single family. And what they put was it went down 20.7%, and it actually 6 days faster. So actually October 2018, it was actually 29 days, and it went down to 23, but they changed the arrow to up. I think in the past they would make it go down, but I think they're saying it's a indirect relationship, right? So we're saying it's actually better. So the arrow goes up, and they took away the color scheme too instead of red and green. So for median condo days on market, that went down. It was 1 day slower at 26 days on market.
Kind of confusing.
Yeah. It is, right? It kind of throws me off.
Not always it's all good.
They changed, they changed it. But I think all in all, it's relatively stable from the prior month. And one thing to look at, we always look at this, is active listings going up. So 5.5% for single family and 14.2 for condos. So and the question that always comes about is, so what does that mean? You know, is it time to buy? Is it time to sell? Is it a seller's market? Is it now becoming a buyer's market? And I think they asked us that last time too. But so my response always to that is, in the past, sellers have been spoiled, right? It's always been such a strong seller's market, and now in the last 9 months now, it's been becoming a little bit more balanced towards the buyer, more inventory building up, right? The active listings building up, but it still seems to be
Still less than 30.
exactly less than a month. And it's evident in the purchase contracts that come through. I mean, you're still seeing as is addendas are pretty much guaranteed going to be coming if the seller for the most part, yeah. So
yeah. Question on the condo price.
Yes.
Does that include the new construction prices, or is that resale price?
that's resale of existing properties. Yeah, does not include new homes.
Okay.
Good question.
Is that what?
How many active listings are there for condos? About
In total?
order of magnitude, like 10,000?
I don't know.
Hawaii?
I don't think. No, I don't think.
1 to 5?
I don't think it would be closer to.
Yeah. So what they're saying is like an extra 100 or a few hundred more this month than normally.
Well, again, this is a year ago, right?
Oh,
so since
okay.
October. So that's another thing to put in perspective is all the statistics are based on
Last year.
October
Okay.
2018 now.
So this is comparing to October of 18, not September of.
Yeah.
Okay.
So in essence, I think it takes out seasonality from that standpoint, right? Because if you're going from the prior month, it's going to be totally wacko, right? So that's why I believe Board of Realtors does that, and most other boards do that.
Just one question. So when you see those statistics, is that based on all home sales or like a certain like million and under?
This is all sales
So it
and
includes
on
high
Oahu.
end?
Yeah. So if you want, I can send you more information that divvies everything up into like tiers, and we can it shows graphically how these things affect. Yeah. So like you said, if it's like luxury homes, it'll be totally different. It's a totally different.
That's why I think they do median and not average, because if it was average, it would be a little lower.
Well, average is also thrown off more by those one-off high or low end
Right.
ones.
The
Yeah,
variance.
But
right?
the weighted average is on lower end, regular people houses instead of multi-million dollar houses. The weighted average is a lot more lower.
Well, if you have 100 houses that all like sell in this area, but you have $1 billion property that sells, the average would throw it way off.
Right.
Whereas
Exactly.
Yeah, but the weighted
It's a
average is
median.
with the lower 100 houses.
So
That's
so
why
the
median
weighted
is-
average.
weighted average, right? So the median, right? If you have 100, this is the 50th,
Yeah.
or the 50 in the middle.
Just trying to get you guys awake here, because I have some slides that are definitely bad data.
Yeah.
So that's the whole thing. Well, that's why we do these things, right? You can't just read these articles without using your brain.
No, that's not. Did anybody order Bite Squad?
Is there enough information here to say, okay, where cycle's turning or a certain way, like condos usually finish a cycle?
So I've heard some pundits say that the condo stats or the condo trends are the ones that are the leading indicators. I've heard that said before, but so far everything's been like every month it's been going kind of like up and down a bit. So if you're like for stocks, are you like the technical analyst? If you're looking, like from a technical analyst point of view, and I can show you these slides, but when you show it, and if as long as it's in that band, then it's not going way off, way down, then it seems to be good. So, and another thing is real estate is very local, right? So it depending on where you're playing, and like to your waste point too is if you're playing in the luxury market, that's going to be affected a lot differently from a macroeconomic correction than the middle C-class properties compared to the stuff on the west side compared to the Section 8 rentals. It's all so different. So it's hard to look at this. A lot of times, this is like looking at like the Dow Jones Industrial Average or the S&P.
And this is
right?
also all from October, and this week the Fed just lowered rates again, so that could just be throwing more gasoline on the fire too.
It's true.
Honestly, I don't really pay attention to much of this personally.
But it
But
also,
we gotta do this every month. Yeah.
so that sort of segues me to my next topic. Where did I go to?
Yeah, you gotta be careful.
Oh, it's very
It's
sensitive.
very sensitive. Be careful how you move.
Okay. Bruh. Get it. I'm pressing it once. Fat finger.
Oh, just use the keyboard then,
Okay. Which way is
right?
return? Oh. Okay. So what I wanted to talk about today was listing your property. Whether you should list it tenanted, vacant, or staged. And the reasons why someone, an owner might want to keep it tenanted when they list it is because they get continued rental income, right? And there's low risk. If they don't sell, they have a tenant in there, just business as usual. I put distrust because it's kind of like you don't trust your realtor to do his job properly, right? So, oh, was he shaking his head? But not a reason why you'd want to, kick out the tenant, but then keep it vacant and not stage it would be, it'll show better than if it's tenanted, and you'll save money on staging costs, right? And the third reason, or the reason why you might want to stage it is because, it helps people see themselves living in that as their home, and you could potentially get more money for that. My quote is, sometimes it takes money to make money. So.
I think it's kind of dumb, but I'm not the buyer, right?
Yeah.
I'm not an emotional buyer. I don't buy houses.
And every situation is different.
Are we talking for sale or for rental?
Sorry, this is for sale.
For sale. Okay.
Yeah. So, thanks for that clarification. So I wanted to show you a visual example of this situation where we have a tenanted place, then when it's vacant and versus staged, and then let you be the judge. So this is an example of a recent listing that I have, and this is it while it's tenanted, right? So we see very cluttered, all the clothes out, we have all the toiletries out, unwashed dishes. And the challenge is, a lot of times you can't control the tenant to clean up.
So much cookies and you
Right. So, and it's challenging for the realtor too in terms of trying to coordinate things and we have a showing. So it's different when you're owner occupied, right? If you're living there, you'll most likely take more time to clean things up and get ready. Say if the agent tells you, oh, there's a showing today, can we do it? Right. So anyway, I just wanted to show you, here's what it looks like tenanted. Then this is what it looks like. The same unit. This is the bedroom, same, and the bathroom and the kitchen when it was vacant. As you can see, no longer feel lived in, and but clean yet sterile. Yeah. And then my third example.
throwing in the curtains.
Yeah. So here's the same place, the same shots, bedroom, bathroom, and kitchen, and now we have it staged. So I don't know, to me, now you have a feeling of purpose. That's the bedroom, and you can imagine living there. You can see the bathroom looks, and again, this is a professional photo, so that gives a little bit of a bias to it, but to me, it looks a lot better. Again, the difference. Vacant, right? Versus staged. Again, vacant and staged.
How much does that cost for was it that one bedroom or two bedroom?
It depends. It depends. Yeah. So this is a one bedroom. I work to deal with the stagers, so it depends on who you're working with and to what extent of staging you bring in. Because you saw this is a full stage. They brought in the couches, the bed, and all that. So flower pot. Yeah. Oh yeah, the whole 9 yards. So these are. I really like these stagers, and you're hopefully For me, I pay for a real stager, a professional stager to come in. And so as you can see, I know when you think A, B, I feel like the eye doctors, which is clear, A or B, A or B, A or C. But
I want to know how much does it cost and how much more are you gonna get?
Okay, that's a good
That's
question.
what I want to know.
Okay.
You know?
And that killed my punchline though. But I don't know if you guys remember Raps Hawaii, but that made me think of Raps Hawaii. Because if you remember Mr. Okada, and if you like soda A or soda X, Mr. Okada, you like the crack. So, but we're getting to Lane's question, right? So my myth versus the truth, right? So it says the myth is that it'll take too long to vacate and stage, and you're gonna lose money. The investor's gonna lose money. That's not always the case. I think if you do it right, you can come out ahead. So in this situation, this unit was repaired, professionally cleaned, staged, and listed in a week of the final walkthrough of the tenant. We got multiple offers, excuse me, and we had multiple offers, thousands over asking, to your question, and we hope to open escrow a week after listing. There was another comparable that was listed and sold just before this unit, and it went for a lot less, and I was really surprised. And because the 1 bedrooms and this is a YPO Gentry. So YPO Gentry is a really small community. The number of 1 bedrooms in that community are also very limited and really not much different.
Yeah, you're really tight comps.
Right. Yeah, exactly. So when I called this other comp that came in, closed a little earlier for a lot less, I was wondering, I was like, oh, what happened? And the agent told me that it sold for less because that there was a tenant in there. They're month to month, but they weren't very cooperative with the realtor and the seller. And so it didn't show nicely. When people tried to come and see, they weren't very cooperative, and that was reason why it didn't sell. So it was like
worth it.
over $10,000 less. So to me, I think the proof is in the pudding. And I just wanted to share that with you guys to give you perspective. And again, it totally depends on the situation, right? Because I mean, stuff in the mainland too might be a whole different ballgame, right? But every situation is different. So the main thing is when you're getting ready to list is to plan ahead. Yeah, giving the tenant notice is really important, and being open with them. Yeah, lining up your vendors. In this scenario, or I've been in scenarios too where the clients wanted to sell, but they were stuck in a long-term lease, right? So they reached out to the tenant, and coincidentally, the tenant's like, oh, you know what? My wife is up high, and we're kind of looking for a bigger place too. We kind of would want to get out of the lease too, but we didn't want to ask. So this communication helped. In 2 months, they actually found a place. The client had me go in early while the tent was still tenanted, so I got a good idea of what the place looked like. So that when they gave me the go, we had everyone ready on the start line to hit the ground running. So a lot of it is communication, because the client told me, okay, it's coming up. Okay, it's coming up. So then now I know, okay, here's the final walkthrough. Let's go. So communication is very important with your realtor. Yeah. So
sometimes you can make your realtor the bad guy and ask that the tenant will leave earlier too. It can be that person who instigates that conversation.
Yeah, that's true. Yeah,
I've had it with my out-of-state rentals where I get my property manager or agent to go ask, hey, have the conversation with this tenant. Do they want to move? Oh, good, they do. I would have never known because I don't talk to them.
Yeah.
I don't want to talk to them.
Yeah. So
it's illegal. I don't want to talk to them. I'm gonna say something that I'm not supposed to say.
It's true too. Leave it. Leverage out to the guys that you're paying to do it.
Yeah,
right?
your proxies.
Yeah, that's a good point. So yep, that will segue to Mr. Kawaoka.
So I write a blog called SimplePassiveCashflow. Do you guys all read it or watch it? Okay, so we can talk about these later, but I wrote these 5 articles. I had a couple of live coaching calls that I recorded, both of them are non-accredited investors this time. We got a lot of these guys for some strange reason. I had my buddy write that W-2 lawyer letter for me. But yeah, we can talk about these other topics after. But you guys found RI Aloha. This is my local group, along with Dean. So we also have a Facebook page that this is going live in right now. Earlier in the month, we had some we've been talking about the China trade. I was going to say the Trump-China war, but it's the US-China trade war, right? So we've been talking about this for almost like the last year, right? The last 2 months, if you notice, we haven't talked about it. It's been pretty quiet. But they were supposed to go talk earlier last month. So I put up this poll just to see how people are like, engaged. And then this is the peanut gallery said, most said, well, Fed will once again cut rates in October, and that's what happened, right? Not a surprise for anybody. So here's something that's kind of small. It's not really that important, but it just happened in the economy. It's called this repo, repurchase agreement. It's when short-term borrowing for dealers in government securities. Dealer sells government securities to investors usually on an overnight basis and buys them back the following day. I had to Google this, and I still don't honestly understand it all, but this is just like the stuff that happens that most of us just sleep through. But basically what happened, the important thing is the Federal Reserve put 200 billion of liquidity into the markets by doing this. And I don't know, did you guys hear about this? It's kind of, nobody ever talks about this.
I heard briefly about it. The Fed's saying don't call it quantitative easing, but it's quantitative easing.
Yeah, so they're calling it
Printing more money kind of thing.
QE.
Yeah, QE3. So I subscribe to a newsletter from Richard Duncan. You guys can read. He did a podcast with me, SimplePassiveCashflow.com/Duncan, but he's kind of an economist. So he follows this stuff. That's all he does pretty much. He lives in Thailand and he just follows this all day long. But this chart is essentially what happened with QE, quantitative easing, quantitative tightening, which happened in a couple of years ago. So basically what happened in 2008, there was this whole global meltdown, right? The government needed to inject all this liquidity into the system to prop it up so that it wouldn't go crashing down. That is what we call today as QE, quantitative easing, where you inject a whole bunch of liquidity, you artificially, all the stocks go up and everybody feels like things are okay. So this happened from 2008 to 2017-ish. And then they kind of stopped doing that, and quantitative easing reversed to quantitative tightening, QT. And that has actually went on for about a year. And if you listen to me and Dean talk the last year, we've been talking about this, as this is a form of what you do is you increase your interest rates. Because when you increase your interest rates, you're essentially getting dry powder, so that in case the economy sputters, you can use that dry powder to get your economy going. And what they did recently in the last year is they gave up. They're lowering interest rates. They're giving up this dry powder so that we don't have the ability to do it. Some people will say, well, the economy is not really that bad. Why are we giving up our dry powder and using up our nitrous oxide now, or whatever, different references, right? Depending on when you were born, right? So right now we're giving up that dry powder right now, and nobody knows why. I have my theories.
One of the reasons that I've heard is that basically it puts companies that basically do all their business here in the U.S. at an extreme disadvantage versus multinationals that can borrow from overseas banks where they're basically at either a zero or a negative interest rate.
Cheaper money.
So in order to basically still make everybody overseas wants to buy U.S. bonds because as cheap as they are, they're still higher than what they get in their own countries.
Yeah.
But by lowering the interest rates, they're encouraging people to put money back into the
U.S. market back into the U.S. companies, and also lowering the cost of lending for those U.S. only companies.
Right. And some people think that it's some kind of like Trump's trying to pressure the Fed into like going in and increasing the stock market. So it's, it's good economy. We're going to reelect him, whatever. Who knows? I don't care. I really don't care. This is why. I mean, look at where the interest rates have been trending, right? Up and down in this band that we're talking about, right? It's really not moving. It's been historically low interest rates. When we buy 200-unit apartment buildings, we honestly don't really care because it doesn't really move the needle. We as investors, we invest off the delta between the cap rate and the interest rate. That usually goes up and down together. So all this macro stuff, I mean, I'm just kind of interested in it, but at the end of the day, it doesn't really matter. So here is this one. I'm going to start to go rapid fire into a lot of different articles. Some will be very interesting. Some might be a little bit boring to you guys. But this first one is a chart of commercial property executive NOI versus the cap rate, a cap X yield. So NOI is basically your profit margin before you take out your PITI expenses. And your cap X yield is how much capital expenditures, how much is this building you got to fix it all the time. So, and this sort of makes sense, like your older assets built in the 1960s have a lot less bigger delta between how much you're making and how much you're paying out in repairs. Your newer assets don't have that big of a delta. So that's that side. Interesting if you're a data person. On this right side shows different asset classes. I like to invest in residentials, your single family home that's residential. I don't really dabble too much in retail, office, industrial, hotel, but those are how those compare.
Would medical fall under other, or would that fall under one of the other categories?
Medical would probably fall under office. So here's another headline: vacancy falls, rents rise for manufactured homes. So manufactured homes are mobile home parks. It's a nice politically correct way of saying that.
They're what?
Mobile home parks.
Mobile home.
Yeah, we don't have it here in Hawaii.
Hey, yeah. Okay.
Well, we don't like to say trailer park. Yeah, mobile homes.
Got it.
Yeah.
What, 8 Mile?
Yeah, like 8 Mile, but I mean, I buy mobile home parks. They don't look like 8 Mile. They're very nice. Yeah. Yeah. So they also rent for, on average, $450 to $600 per lot rent, and this is broken up in regions: East, Midwest, Southwest. Right. So on the West Coast, you can buy some mobile home parks for $250,000 that are really nice in LA. It's crazy, right? But for the most part, you're buying these things for 30 to 50 grand per unit, and those are the lot rents. And this article is saying vacancy rates are very low. When I compare apartments or single family homes, full occupancy is 90% occupied. But when I compare it to a mobile home park, 85% is sort of full occupancy.
And when you're buying the park, you're buying land under it, or you're buying with?
You're buying it with the assets on top, but you're trying to make it, if you're smart, in my opinion, I mean, you can do it anyway, right? But in my opinion, you don't want to own the overlying assets. When the tenant screws up those properties, that's their problem. So here's another article that I have here that is fake news that I don't like, that it's, as an investor, you should read these sort of articles. This is from Multifamily Housing News. It says 5 markets with the greatest occupancy loss, and Midland, Odessa, Chattanooga, Youngstown. So those are more like sub-markets. They're very smaller. They're not a city. They're not big cities. They're not states. So you can kind of look at it and be like, oh, I don't want to invest in that area. But a lot of times you need to look more into sub-markets of Chattanooga or Youngstown. Right now, my partner is selling his Chattanooga property that he's going to make a killing on. I sent this to him the other day, and he just laughed at it. That's what a sophisticated investor does. They don't invest off major data. So you're talking about seasonality. So this is more on the rent side. So you're comparing each month how the rent increases go up. And this makes sense, right? Because in the cold months, October through early spring, April time, your rent increases are not going because you're desperate just for people, period. But in the summer months, when people are moving around, that's when you kind of make hay on your rent increases. So that's where you're looking for anywhere from a 1% to a 3% rent increase. So on the right side here, you're looking at the latest data, 2018-19. We're going okay. 2013 to 2016 were great years. I mean, places like Dallas were going up 5-6% every single year, unsustainable. I think that's more of a normal.
Any mainland investors got any vacancies right now?
Better fill them.
Yeah, I know. I saw Chicago. I think is the big snow, right? That's week. I'm invested in Chicago.
Yeah, if I had a vacancy right now and it was like my rent price was 900, I would drop it at 850 today. Just get somebody in there. So you guys can check out these slides online. I have the PDF slides. Usually on the website, but ALN does a good report. I'm not going to go through all these, but you guys can read these if you're interested in a particular area.
They said sophisticated investors don't buy.
Well, it's good to kind of know them in comparison to other markets. I think that's the important thing.
When you're starting off too.
Right.
Yeah.
Right.
It's a good place to start.
So I threw in this here because people in Hawaii love Las Vegas and they're very interested in what's happening there. So the Bellagio is going to get bought by MGM Resorts, and so is Circus. They're going to get bought. But the reason I put this in here is, this is an example of A-class, B-class, C-class assets. As they start to get older, they start to trade hands. So I would call Bellagio is a great place. I think it's one of the top tier places, but it's not an A-class hotel anymore. It's several decades old, right? Yeah. So I know they're building some new hotels, so those will take the place of Bellagio. But this is just like your luxury condo out in Kawaoka. Soon they'll be old. Nobody will want them. Well, somebody will want them.
But the next best thing will come up, right?
Right. The next best thing. So these commercial assets do have life. So here is saying Chicago. I don't know if you knew this was gonna come up.
No,
you knew this was gonna come up. So I'm just taking a stab at Chicago and the whole state of Illinois right here. I mean, everybody wants the heck out of Illinois. This is kind of a fringy article, mishtalk. I had a buddy send this to me, but data doesn't lie. This is from the Census Bureau, and you're looking at Illinois just going down. Some people think that this is the sole reason why Indianapolis population is going up. Indiana is like the only state in the northern plains where the population is going up. Makes no sense. But now Illinois sucks because everybody's moving over there to Indiana, perhaps.
And KC more too, possibly.
Yeah.
Kansas City, possibly. But not as much.
Yeah.
It could be Kansas City, Missouri, possibly.
Yeah, Kansas City is like another place where it's cold.
I think it's real similar to Indy. I think they're pretty similar, especially in terms of demographics.
A lot of people have bought turnkey rentals from some turnkey providers that have gone belly up. So that's why I'm not a big fan of Chicago either.
I know what you're gonna say.
Yeah. So this came from a commercial investment magazine or news article. So this is more for your shopping mall investing viewpoint. So this, if you guys seen these Capital One commercials with the guy with the coffee shop in the bank, you don't see this in Hawaii. None of this happens in Hawaii, but apparently this is happening on the mainland, right? They're having like coffee shops inside of banks, and he's gonna give you 5% or 5 times his better interest rate. So I guess 1% or something measly like that.
Oh.
So the article says they point out the big F's: food, fun, fitness, fashion are the big drawers to shopping centers. I gotta catch myself, not shopping malls. Malls are like the big box and like luxury brands. The shopping centers are the ones, the neighborhood centers with the grocery center.
Strip mall kind of thing.
Yeah, with the L&L drive-in, the bubble tea in Hawaii, of course, the barber shop. Those aren't going away. And so this came from Arbor, who was a multifamily lender, direct lender from Fannie Mae, Freddie Mac. So they put a lot of good mutual information out. So this chart is a discussion between the different caps and different tiers. So I'll define what these different tiers are. Fannie Mae, Freddie Mac, they have 3 tiers, tier 1, 2, and 3.
It's like A class, B class, C class?
No, so tier 1 is your top markets that they have defined as, hey, these are our top markets. Not to say they're better to invest in or not. These are just these are the lower cap rate type of markets like your Los Angeles, San Francisco, New York, Boston. Dallas has sort of become into that tier 1. People will argue that that is a tier 1 these days. Your tier 2 markets are your markets like that we all like to sort of invest in, like Las Vegas, Birmingham, Atlanta, Indianapolis, Kansas City. The tier 3 are your tertiary markets. So this is important for multifamily investors is because based on a lot of time, if you're going after non-recourse lending, you're going to go after your maximum leverage. So Fannie Mae, Freddie Mac will only give you a certain amount of leverage based on what tier it's in. So if you're in Atlanta, which I believe is a tier 2 market, I'm kind of guessing here, but I think you can only go up to like 75%, 85% LTV.
That sounds pretty good, no?
Yeah, yeah. The other tier 1, they'll go up to even higher because they feel like it's less risk. But with less risk comes less reward and less yields. So it's just good to kind of, whenever you're learning something, it's good to learn the lingo and these different nuances. Yeah.
What's their definition of small multifamily?
I believe that is, they have a large multifamily market report, and that's like Orlando and those types of markets. I like to pay attention to the mid and small multifamily markets because those big markets.
Oh, so it's not, I was thinking that's like, number of units per property. But that's actually markets.
I do believe it's markets. I don't really pay attention to the big one because I always see like those tier 1 type of markets, those cities in there. But I don't know, I read all of them. Honestly, I just put it all in and start reading. Here's another example for a potentially bad article in MarketWatch, which I'm not a big fan of, but they write a lot of really good like clickbait type of articles with really nice pictures and engaging graphics like this one. And
I'm a sucker for these two.
yeah, but they're like, if you look at California, they're putting it in the tier which is tax friendly, and we all know it's not tax friendly. It's one of the worst ones out there.
Why is it mixed?
But
Right?
But what I was thinking about, I think what they were trying to go for here is like just for property taxes percentages. But you can always look at it 2 ways. Like, and this is where you have to get past like the newbie level, and you have to really understand what is being said by the data source or the person. For example, Texas, everybody says the housing tax is really high, right? The percentage is really high, which it is. But the prices are so dang low comparison to California. I tend to look at it more from a perspective of, like, at the end of the day, how much money am I paying in taxes? That's how I evenly weight that.
For me, I'm looking at the bottom line, right? So the taxes could be relatively higher, but maybe the rent rates cover
Right.
that, right?
Like Chicago is a perfect example of that. Their rents are like way higher. So a novice investor will be like, oh, the rent to value ratios are like 1.3 for a similar property and wherever for 1.0% rent to value ratio. But then when you look at it, the taxes are like almost double that of Alabama.
Not only that, but like for Chicago, I think, to me, like you said, you get the novice versus the savvy. So, and I'm not claiming to be a savvy investor at all, but when I was looking, and I only have one small unit in Chicago, a little north of the Millennium Mile. But the unit that I bought in the complex that I bought in, the association would go about, we had a very smart association, and they will file for appeal for the real property tax every time it seems high. So that makes it low. And you compare the different comps within the area, and you see, why is this so high? And you talk to the association or the managers and say, oh, we go in to get the appeal every time, and we get it. So there's like not to say a game, but a system. And if you get these systems, then it might be more advantageous to play in these areas.
Another example is like in Texas. Texas is probably the most horrible place for tax increases after you purchase property, because property values are going so much, and if they're pretty much rebuilding all the highways out there, they got to pay for this somehow. So a little dirty secret is a lot of guys, they'll trade properties in the LLC, so that down in the South, a lot of the privacy is in such a way where if it's traded in that manner, you don't see the property trade hands, therefore they don't really trigger an assessment. But lately I've been hearing that that's not a foolproof way. You shouldn't create your pro forma based on what the existing tax is, because you're going to be unlucky. They're going to come after you. But yeah, to your point, like what I would suggest people do is download like my free analyzer. You guys can download it at SimplePassiveCashflow.com/analyzer, and it's a spreadsheet. Make your numbers by yourself and put your real taxes, put your real, flood insurance, hurricane insurance if you're buying down by the Gulf, and see what you cash flow at the end of the day with those different variables. So going into holiday season here, NRF survey shows in RE Business Online that the holiday shoppers plan to spend 4% more this year. I don't know how they come up with that information, but they're pretty bullish on it. I say let's wait and see what happens. Another article says retail post positive quarter. So these are good news, right? Like the people were spending money, we got some money. I mean, it's been over a decade since a recession, right? Should have some savings. I've been reading this book, Gary Vaynerchuk, Crushing It. I have mixed reviews on it. But if you guys are interested in any more stuff, I have a YouTube channel, and we put all these on the internet at RA Aloha, and we now have a podcast. We do. We do. Stitcher, iTunes, and we are not acting in legal tax or any manner like that. We're just giving out edutainment, as Dean says. If you guys, I do this food things, I save a lot of time doing this. I don't cook, neither does my wife. Waste time. But this is the point in the presentation where you guys ask whatever questions, and then we'll kind of do some networking.
Free real estate investing group, check out reialoha.com.
We're just two local guys with so much to say, so listen to the real estate Braddahs today.